Hello everyone, and welcome back to our derivatives course. In our previous lectures, we covered various spread strategies such as bull and bear spreads, which are based on price direction. Today we'll discuss a different kind of spread, the calendar spread using call options, also known as a time spread. We'll review how this strategy works, how it's constructed, and when it performs best in real markets. A calendar spread using call options is a strategy that involves selling a short-term call option and buying a longer-term call option with the same strike price point. Both options share the same underlying asset and strike, but have different expiration dates. The key idea here is to benefit from the passage of time and changes in implied volatility rather than large price movements. Traders use this strategy when they expect the underlying price to remain near the strike price in the short term. Let's go through the construction step by step. Step 1. Sell one short-term call option, for example, a 1-month call. Step 2. Buy one longer-term call option, say a 2-month call, with the same strike price. Because the long-term option costs more, the strategy results in a net debit. You pay to enter the position. The short-term call decays faster as time passes, while the longer-term call retains value. Your goal is for the underlying asset to stay near the strike price when the short-term call expires. The profit and loss of this strategy depend on the price of the underlying at the short-term option's expiration. If the stock stays close to the strike, the short call will lose value quickly and expire worthless, while the long call retains time value. That's your maximum profit zone. If the stock moves far below the strike, both options lose value and you take a small loss. If the stock moves far above the strike, the short call increases in value and offsets most of the long call's gain, again resulting in a small loss. Your profit zone is narrow but clearly defined around the strike price. The maximum loss is the initial debit you paid to enter the trade. Let's look at an example. Assume the underlying stock is trading at $100. You sell a 30-day call at the $100 strike for $3.50. You buy a 60-day call at the same strike for $6. Your net cost, or debit, is $2.50. If the stock stays near $100 when the short call expires, the short-term option decays quickly and expires worthless, while the longer-term call still has time value. You might even sell it for a profit. If the stock moves sharply below $95 or above $105, both calls lose value relative to your initial cost, and the trade shows a small loss. Your maximum profit occurs near $100, and your maximum loss is limited to $2.50, the debit you paid. If you plotted this strategy on a payoff diagram, you'd see a smooth bell-shaped curve centered around the strike price. Your profits are highest at the middle, when the stock price equals the strike, and losses appear on both sides as the price moves too far away point. This visual represents that the strategy works best in stable or range-bound markets. So, when should you use a calendar spread with calls? This strategy is ideal when you expect little near-term movement in the underlying, but think volatility may rise. It benefits from time decay on the short-term call and from rising volatility, which increases the value of the long-term call. With respect to Greeks, delta is close to zero. It's a neutral strategy. Theta is positive. Time decay works in your favor. Vega is positive. Rising volatility benefits you. This makes it an excellent choice when markets are calm now, but expected to become more volatile later. In summary, the calendar spread using call options is a limited risk, limited reward strategy that profits from stability and time decay point. It's built by selling a short-term call and buying a longer-term call at the same strike. The strategy performs best when the stock remains near the strike as the short call expires. This concludes our discussion about the calendar spread using call options. See you at the next lecture.